When people say they want to start investing, the real question they're asking is simple. What do I actually put my money into? Not concepts, not motivation, real choices. Let's break this down clearly and practically. First, before investing anything, make sure this money is long-term money. If you'll need it within the next 2 to 3 years, don't invest it. Investing works best when you can leave the money untouched and let time do the heavy lifting. Now let's talk about what to invest in. For beginners, the strongest starting point is broad market exposure. Instead of individual stocks, that means investing in funds that represent many strong companies at once, rather than trying to guess winners. The first core investment is a broad equity fund that tracks large established companies. This gives you ownership in businesses across multiple industries instead of relying on one company to succeed. It spreads risk and removes the pressure of constant monitoring. The second option to add once you're comfortable is a global or international equity fund. This gives exposure beyond a single country and reduces dependence on one economy. It's not required at the beginning, but it improves diversification over time. If you want more stability, especially if you're risk-averse, a low volatility or asset-backed fund can balance your portfolio. This helps smooth out market swings while keeping your money productive. Now let's talk about how to invest. Step 1. Open a basic investment account that allows regular contributions and fund investing. You don't need advanced tools or frequent trading access. Step 2. Choose one primary fund to start with. One is enough. Complexity at the beginning increases mistakes, not returns. Step 3. Set a fixed investment schedule. Monthly works best for most people. Investing regularly removes the need to time the market and builds discipline automatically. Step 4. Automate the process. Once investing is automatic, emotions stop interfering. Automation is one of the biggest advantages beginners can give themselves. Step 5. Leave it alone. Checking daily does not improve results. Long-term investing rewards patience, not activity. Here's the key idea many beginners miss. Success comes from consistency, not cleverness. You don't need perfect timing, secret strategies, or constant changes. You need exposure, time, and discipline. As your knowledge grows, you can improve, adjust, and diversify further. But your first job is simple. Start with something solid and stay consistent. Investing doesn't have to be complicated to be effective. Simple done consistently beats complex done occasionally. Start clear, start small, start now.